All right. Hello, everybody. We are talking today about underwriting. My name is Tim Johnson. This is Matt Johnson, my brother. We are owners of a real estate company here called D1 Agent Group in Phoenix. And we're going to be talking about underwriting and more specifically, how to use tax strategy within your underwriting to make decisions about your investments, right? And so a lot of people just make decisions on their investments in real estate based on cash flow. And so we want to jump into how to really take a more holistic picture of what real estate is and all the benefits that are available to you so that you can make a more informed decision when you are choosing to invest in real estate.
Right. We look a lot at the tax benefits and how we can take advantage of those as real estate professionals. But it's not the only decision when underwriting. We need to make sure we're looking at all of the things. And in the same way, the things that we're looking at, cash flow and mortgage reduction and appreciation, no one of those things is the only factor. We need to look at the whole picture and see what it's going to do for us as an investment overall.
Right. And who's going to benefit the most from kind of one of the additional things that we're going to talk about, tax strategy in this underwriting section, is the real estate professional.
Exactly.
Right? So we work with high income earners, and then we also work with real estate professionals. So business owners who are in that real estate realm. Matt, break us down. We have another video on this, breaking down how to qualify as a real estate professional. But there are some really cool tax benefits that we will, break down for you in this video. Real quick, who is a real estate professional?
So a real estate professional is somebody who works in the real property trader business. They work more than 750 hours, and more than half of all their time spent is in a real property trader business. And the IRS defines a real property trader business is one that does any of the following. It's going to develop or redevelop real property. It's going to construct or reconstruct it. It's going to acquire it, convert it, rent or lease it, operate or manage it, or broker it. We break down a little bit about kind of what those look like in other videos. And the IRS publication 925 does some explanation on a few of those as well, if you need clarification on what those are. But those are the people that we're talking to, somebody who is considered a real estate professional in the eyes of the IRS. This underwriting process, three of these things are going to work for everybody. The fourth thing, the tax advantage that we talk about, is really talking to the person who is able to claim that real estate professional status.
Yep, exactly. And real quick, we touched on this kind of as we entered this video, but like, why is this important? Again, cash flow is not everything. And we're entering an environment where we're coming out of like a 15-year period within real estate where, hey, we can buy houses for a lot cheaper. And this might depend on your market as well. So here in Phoenix, Arizona, we're starting to trend a lot closer to like California, where cash flow is really, really hard to come by. It's not impossible to come by it by any means, but how do we take advantages of the other things in real estate to go ahead and help us in our overall plan?
Yeah, you hear the news around the idea of investing in real estate in the current market, and there's a lot of people that are just hanging out on the sidelines. A lot of people that are saying, "Hey, there's a time to buy it all up, and there's a time to sit on the beach." Exact phrasing I've heard before, and they're saying now's the time to sit on the beach, and that could be the case. Some of the things that we see in this market in the Phoenix area is the time that houses spend on market ends up being a little bit longer now. We got places that are needing to sell. People are still selling their homes and buying other homes. And those properties sit on the market a little bit longer and allow for just a little bit of extra negotiation on the buyer side, which can be helpful. And so in the current market, there's some reason to get involved. And if we run our numbers and things are still looking good, if we're talking about staying out of the market for 4, 5, 6 years to wait for everything to magically get better, we might be missing out on some cool value here.
So. Well, and a lot of people talk about how real estate is a hedge against inflation, right? And so if we're anticipating any inflationary times coming up, obviously we just printed a load of money in the past 4 years in our economy. And so sticking your money into a hard asset like real estate can help hedge against that, because your money is in an asset. The value of that asset goes up disproportionately, and then you can take your money back out, right? And you didn't lose value. You had it into an asset that gained value. And so Some really cool things there. Another thing to point into as we kind of dive into our underwriting session here is real estate is highly localized.
Yes.
It matters location, 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 right? You hear that from Selling Sunsets on Netflix when they're talking about buying and selling houses. Location matters. And so you can go find cash flowing properties in the Midwest. You can go find them in Memphis, right? But like here on our market, we are in an appreciation market right now. Again, cash flow isn't impossible to find here. We just want to talk about the other benefits that come alongside real estate as well. So, well, let's dive in. We're going to be looking at real numbers today. So actual property on the market just came on the market today. It's a 3-unit residential property here, something that most people can buy and have access to. And so we're going to break down what the actual rents are that are coming in on the property currently. We're going to do an actual underwriting in terms of cash flow to know what our expenses are. We're going to actually set aside 5% for repairs and maintenance, 5% for vacancy, 7% for capital expenditures. We're not just going to hyperinflate the idea of this rental being a great purchase, right? We want to show you real numbers, what it looks like to buy with an 8% interest rate right now in our current market with a property that's on the market right now on the MLS. So
right. There's some of these calculators too that include those, the CapEx, the vacancies, the repairs. Some of them will also include management fees. Just of note also, we're running this under the assumption that I'm working as a real estate professional. I am materially participating in this property. I'm not paying a 7% management fee to somebody else. That's something that I'm going to be working towards anyhow. So just another thing to note there on how we underwrote this.
Yeah. So, all right. So we've got this property. The address here is 2102 West Minnesota Ave. I'm not afraid of you sniping this deal from me because I'm actually the listing agent. So if you are interested in this property after we give you a full underwriting session on it, go ahead and reach out and I would love to talk to you more. But let's dive into this. So it's listed at 525. We have an appraisal, and I have this actually listed here. It just appraised a couple months ago at 535. So the value is there. We're listed at 525. It's a 3 units. We have 1 unit. Unit A is about 1,000 square feet. It's a 2-bedroom, 1 bath. Unit B is about 500 square feet. It's a 1-bedroom, 1 bath. And then unit C actually, and that's about 750 square feet. It's a 2-bed, 1 bath, and it has solar on it. And that's going to be nice for your kind of utilities for the tenants as well. Little perk there. So it's located in an opportunity zone. We're not going to necessarily dive into that in our underwriting session today. It is in a qualified opportunity zone that offers a unique advantage with tax benefits if you want to go ahead and take advantage of them. There's some extra hoops and steps to jump through though if you're looking to do that. Built in 1968, it's about 2,300 square feet in total among all 3 units. It's on a corner lot, flood irrigation. It's got grass, right? Some good things for tenants to enjoy. So just came on the market. Let's go ahead and take a look at some photos just so you can see that this is real. Here's the front. This is Unit A. The main house is Unit A and Unit B, so that's a duplex. There, that's Unit B front view, and then we've kind of got this gate / driveway that separates the houses. This is Unit C. This is the detached guest house. All right, this is inside. So pretty standard rent ready, right? It's nothing crazy. There's no crazy updates right now in this property. Rent ready. It's tenant friendly. It's fairly bulletproof. It's got this, the tile all the way throughout the house. Kind of standard rental for what you'd see in the area. And across all 3 units, we are bringing in right now $3,900 a month. Okay, so that's our income across all 3 units. You can raise the value of this property pretty easily with just a little bit of repair and maintenance here. Clean up the backyard, clean up the exterior of the property, add maybe some fencing in the front to make it a little bit more secure for tenants, whatever you want to do. But there's ways to force the appreciation on this property as well. So it's not maxed out in terms of value. And one thing that Matt and I noticed when we've been in the neighborhood there is this isn't the nicest house on the block. A lot of the houses on either sides of the street, on either sides of this, are updated. And so that's a really good feeling for when you're buying into a neighborhood, is saying, okay, I've got some room. If I wanted to throw some money into this, I'm going to get my return on that. And so anyway, this is a real house. just wanted to show you this. And let's dive into the underwriting portion of this and show you the numbers as well.
Yeah, absolutely. So as we look at the underwriting, we've got 4 different things that we're going to look at today. We're going to look at the cash flow. That is as Tim mentioned, we take all the expenses, including the repairs and maintenance and potential vacancies. And then we take the income that we're bringing in. He said $3,900 in rents currently on the current leases, and all of that's factored together to figure out how much money we are bringing in per month, and then over the course of a year as well. We're also going to look at the amount that the total mortgage principal has been reduced by the tenants paying that down over the course of the year. Third thing we're going to look at is the amount that is appreciated. Now, appreciation is one that is very local. We looked at the total appreciation, looked at Redfin stats on this particular market, this zip code, and over the last year, even in the market that we've had here with kind of weird amount of sales and timid buyers, high interest rates, all of that, we're still seeing about a 5% appreciation over the last year. It got crazy. There was a 20% appreciation over the COVID years, and some weird stuff happened throughout the country, but throughout our area, specifically in Phoenix.
Yep.
And it's kind of stabilized down. Overall for the U.S., I think is about 5.5% total for total appreciation over the last bit too.
Yeah, that's in a high interest rate environment, and that just kind of speaks to the low inventory problem that we have kind of across the United States.
Yep.
So we just don't have enough housing, and things haven't really caught up, and we've been trying to catch up. And so it's been continuing to force prices up still, even with high mortgage rate environment. So
that's not guaranteed to hit all the way out through these projections, but it's the numbers we have to work with, and we've kind of based it on the low end of what it might do too.
And we took the last year because we didn't want to take a 5-year projection, because then we're including the COVID years. We had crazy 20% increases in values during that time and each year. So we just wanted to look at like, okay, what did it do when market opinion hasn't been super strong, and when it's been difficult to buy houses with the high interest rate and mortgages. Yeah, exactly. And so, hey, if that showed 5% over the last year, it can get worse, but the chances are it's probably going to be pretty stable somewhere right in there. Could be when we average it out over the 5 years. So let's dive into the cash flow. This is our underwriting quadrants. These are all the different sections that we go over. So don't mistake it for when we say cash flow quadrant. We are not talking about Robert Kiyosaki's cash flow quadrants.
Not the same thing.
We're just talking about this quadrant right here, cash flow. So this is where everybody does their underwriting, right? You jump on a bigger pockets calculator and you plug in the rents that you can get. You plug in how much your mortgage is going to be based on interest rate, how much you're putting down, how much you're buying the property for. You're going to go ahead and equate how much you're going to set aside for repairs and maintenance and vacancy and capital expenditures. You're going to set aside how much taxes are. All of this, you're going to figure out, am I making money each month, right? That is like when people think of underwriting, that's what they think of. Yep. I'm going to underwrite the property. I'm going to see if this makes money. Okay. Right. We're going to spare you even just looking at that spreadsheet. We did a quick underwriting on Bigger Pockets calculator, and we took into account setting aside 5% of the gross rents for repairs and maintenance, 5% of the gross rents for vacancy, and 7% of the gross rents for capital expenditures. A little bit older home, we wanted to set aside a little bit extra money for AC that goes out, a roof that goes out, right? So we're setting aside, in that scenario, we're setting aside about $700 a month just to cover those potential roadblocks, right?
The intent of that money is to build up reserves for when we need to spend it.
Exactly.
So the person that goes into a process like this, you may have $60,000 sitting in an account right now for reserves to cover this sort of thing. This cash flow that you see here in this is going to be a little bit better because we're not pulling that amount out. You spread that out over the course of a 5-10 year hold period, and the amount you're actually spending versus the amount you're actually bringing in might balance out to about this as well.
Yep. So in our calculations, we did a purchase price right now of list price right here, $525,000. We know that it appraised a little bit higher, but we purchased it right for list price, $525,000. We did a 20% down payment. which is about 115 and some change, $115,000 down payment. And we had an 8% interest rate. So calculating our PITI, all the other expenses that we are estimating that we just went over, and then calculating that against our gross income from the rents we're currently bringing in on the leased units, we are sitting at negative $84 per month.
Yeah. That's rounded to that. You'll see the next number, our total annual doesn't equal 84 times 12, but it's averaged out. So total for the year, we're looking at $1,017 that we have had to pay out of pocket if this all plays as we calculated it.
So when we're looking at properties, I mean, you'll see a lot of underwriting videos like this where they're like, oh, we bought a $200,000 house and we're renting it out for $4,000 a month. And this is amazing. We're cash flowing great. We're just looking at a real property. I mean, this is not a bad property. It's a standard, something standard that you'd see on the MLS right now. In my opinion, it actually is a pretty good property for what it's priced at and what the cash flow actually brings in. 20% down payment on this, you're pretty much at a break even. We're at a negative, right? But you're right around that just break even point where this is, again, setting aside money for all of those potential things that might happen. What if some of those things don't happen? Right. You might be right around zero. Okay.
Right. And as you run these calculations, you'll notice that like later years, as you increase rents year over year, about 2% or so, you're going to start having a different cash flow projection for year 2 and year 3 and year 4 and year 5. So the calculations that we do for the 5-year projection aren't going to look like $1,000 times 5 in the negative. It starts to get better over time. By the time you're at year 30, you've paid off the loan. Your repairs still might be there, but your actual cash flow is going to be a lot better than you're sitting at on year 1 of a 30-year mortgage.
Right, rents have increased. You've got more money going towards the mortgage. So let's actually transition into the next quadrant right there. Mortgage reduction.
So we pulled up a calculator here, a mortgage calculator, punched in the 8% interest rate on the loan, the $525,000 purchase price, 20% down. And we end up with mortgage being reduced, the total principal coming down on that loan by about $3,500 in the first year.
In year 1. So that means our tenant reduced our overall mortgage by $3,500.
Right.
That's great. So that is, we're reducing the mortgage, but we're going to go ahead and say that this is a positive number, right? That's cash in our pocket. That means when I go to sell that's $3,500 that I get, right? That my tenant ended up paying down when I sell the property. Let's jump to appreciation. We touched on this obviously in the video already, but appreciation is, we want to go super localized with that. So we pulled the data from Redfin from this zip code 85015. We looked at single family homes. In this area, it came out to be right around 5.5%. We're just going to go throw in 5%. It might be a little lower, it might be more, whatever it is, right? But we're just going to go ahead and throw that estimate down there for our appreciation. So year 1, what does that look like in terms of price? Well, the overall value of the house went from $525 and it went up 5%, which comes out to be $26,250. So the value of the house went up $26,250. And again, this is why real estate is so cool, because we get leveraged appreciation. How much money did you put in? You put $115K in. Well, the overall value of that property you're not getting a 5% return on your money. You're getting a 5% return on the overall value of the asset.
Right.
You put in 20% of that money, right? So you get a leveraged depreciation here, and we'll show you kind of how that looks when you run this. The next one, do we want to add up that? Let's go ahead and add that up in terms of what our potential return would be.
Yeah, absolutely. So our total, we take the $1,017 plus negative $1,017 plus $3,500 plus $26,250, and we end up with $28,733. So if we look at we're holding this property, we're hanging on to it, we've put $115,700 into the down payments, and we're going to gain back $28,733. Not realized yet, but this is something that has come back to us and could be available to us in HELOC or a cash out refi later, that sort of thing, or if we sell the house later, we'll talk about that a little bit. But that's the amount that we've come up. So total return on the $115,000 that we put in is looking at about 24.8%. Again, unrealized, that's sitting there, not super liquid, but it is value to us.
Important to note, this is not your real return if you went and sold this in year one, right? Because you're going to pay real estate agent fees. That's 5% plus another percent in closing costs. You're looking at 6% on your total that you sold this property for. I mean, that eats up all this. So the goal here is to show you, what does a real number look like? What would it look like to sell in year one? Okay, when we ran our projections, you should not sell in year one.
That's generally accepted truth.
Yep. And next, we're going to end up looking at, what does a 5-year period look like? How does this kind of change our overall? And we'll give you what it looks like, even if you used real estate agents and everything to sell the property, and what that return on your investment will look like.
So this sort of number is realized by anybody who purchases this house as an investment property, right?
Exactly.
What we're going to talk about next, though, are the tax benefits that are available to a real estate professional. So let's break that down a little bit.
Yeah. So we're going to go over the value of the house. All right. When we bought it was $525.
You don't get to depreciate the full 525. How do we find out the value of the land that we're not allowed to depreciate? Right? You hear it all the time online. Just find it on the tax records. We looked on the tax records. We couldn't find a dang thing. It just was not there. Where we ended up finding an actual dollar amount, though, was from the appraisal.
Yeah. In this scenario, we have an appraisal for this property. So that was super helpful. In that appraisal, the appraiser went ahead and gave the land value as 30% of what the total value of this is. So what we're going to do is, we can only depreciate the structure. So let's go ahead and eliminate the land. So 525 times 70%, because 30% of it is land.
Yeah. So your total structure then is sitting at $367,500.
Perfect. So this is our structure value. So now we're going to go ahead and run a cost seg, and we're going to itemize the components of this house. Now, we have other videos on cost segregation studies if you want to deep dive into what that is. We're just assuming right now that you know what it is. If you have questions, let us know. We're going to run a cost segregation study on this, and what we've seen in a residential property like this, with the current year being 2024, which is 60% bonus depreciation, we're going to get a ballpark of probably 18% to 22% of the value of that structure in year one in depreciation. Okay, so we're just going to take ballpark average. Let's go 20%. So we're going to take the structure value here. I'm going to multiply that.
So we'll be able to depreciate that structure value down by $73,500, give or take, in year one.
Yep. Awesome.
So the person that runs this, let's say that they're in the highest tax bracket. They're paying 37% federal tax rates. 37% of $73,500 is $27,195. So that is $27,195 that you are not paying to Uncle Sam this year, but you have the opportunity to then turn around and reinvest again into a similar asset if you would like.
Real tax savings.
Yeah.
That is that, we went ahead and deducted the $73,000.
Right.
This is real money that you would have paid Uncle Sam that now you get to keep in your pocket. You get to keep it, and like Matt said, you get to reinvest it. So if we really wanted to include that, I mean, that basically just doubled our return. It's almost equal to the 24.8% right there that we have just from the other three areas of the deal that we're looking at. And so that's really cool.
Now, that money there is something that is deferred. You're putting your money into a tax shelter that you're able to defer the taxes on that, and you would only then pay taxes on that when you sell the property. If our goal is to hold the property for the rest of our lives, we can ultimately not pay the taxes on it unless tax laws change in between now and then, I guess. Yep. In the meantime, though, we're going to hold on to that and reinvest that money and use that to snowball our efforts in the overall process. And you saw a video a time or two ago where we talked about a property bringing us a 150% return, 50% return in 1 year. That's where this comes from. It's factoring in the additional tax savings also, and pretending that that's something that we're just going to hold on to. Our intent is to hold that property.
Yep.
But for the average investor, for everybody else, a 24.8% return in year one. Still looks pretty good. It looks a lot better than just the math on, hey, I'm spending $100, I'm spending $85, $84 a month to keep this property floating. That's something that can really mess with somebody psychologically, where they're saying, this thing is costing me money month over month over month.
Yeah.
You listen to, again, Cashflow Quadrant. You listen to Robert Kiyosaki's book on Rich Dad, Poor Dad, and he talks about how like an asset is something that brings you money month over month. A liability is something that takes money away from you month over month. Absolutely true. If that's something that's going to psychologically mess with you, just make sure that we are looking at the overall picture here. We're still looking at debt reduction. We're still looking at the appreciation that thing's going to bring. Those aren't like strict numbers that we can guarantee, but I guess the debt reduction is that we continue to make our payment in time. We're still going to reduce the amount that we owe on the principal of that loan by about $3,500 this year.
Yep.
Good chance we're going to see appreciation as well. So we want to make sure we're looking at the overall picture. And year over year, this is going to bring us money, as it looks like.
Yeah. Yeah. Okay. So let's transition. We just showed you a quick breakdown of year one. Let's go ahead and transition and just do a 5-year outlook here. So just going to draw a line, scroll up a little bit. Okay.
So we talked a little bit there about the overall cash flow changing a little bit year over year. So as things begin to change in rent prices, all of that. So we added up the kind of projections with a 2% increase in rents over each year, and cash flow as we add all the 5 years together at the end of the 5 years, we're looking at $2,249 that we will have cash flowed in that time.
I'll catch up to you here.
He is catching up.
Yep. So to just recap that, negative in the beginning, we ended up going positive because of the rent growth that we're anticipating.
It gets better over time.
Over 5 years, we have a total of $2,249. So
now, if we do our entire underwriting based on that, 2249, I'm just doing math. I don't know why I feel the need to do this. Divided by 5 years, we're looking at $450 a year that we've gotten on cash flow alone. That's not great. Like if that's the only thing we're looking at, this isn't a property we want.
No. Yeah.
Right. We're looking at the overall picture, though, big picture.
Yep.
So moving on to mortgage reduction. Again, as you look at an amortization schedule, year two, you end up paying just a little bit more than you did in year one in the principal. Year three is a little bit more. Year 4 and 5 are a little bit more. Adding all 5 years of those up, over the course of 5 years, we will have renters that have paid down our mortgage by $21,548.
Woohoo!
Yeah, it's beneficial. That's great. Yeah. And that starts to look a little bit better when we talk about our overall return on investment.
Right. As the mortgage goes ahead and gets paid down, and as we see the property value rise in value, that's our equity. That gap is our equity. And so when we look at that gap, the mortgage reduction is just as important, right?
Yep.
Because that can make a big play in our total, in our return on investment.
Exactly.
So what is the appreciation? So we're going to stick with that 5%,
yep.
right? And we're just going to go ahead and multiply that out over 5 years. Quick math, that puts our overall value of the house at $670,000, right? So we bought it for $525. 5 years later, at 5% average appreciation growth annually, we're looking at a new value. Sorry, bear with me. New value of $670K.
Yeah.
Okay. And then from there, what is the gap in terms of that 525 to 670?
Yeah, we have $145,000 that has appreciated over the course of 5 years.
Yep. So awesome. That's the number that we mostly care about right there, and right there.
Right. So add it all up, we have a total over the course of 5 years between those three line items of $168,797. Unrealized return on that investment ends up being 29.2% year over year.
What did you say that was, Matt? 168?
$168,797.
797, right? How much did we have into this property?
We had 115,700.
So that's cash in 115,700. Okay, awesome. What is our 5-year return on investment?
Absolutely. So total return on investment, we divide 168,799 into 115,700, and we get a percentage that we need to then divide by 5 years. So 168,797 divided by 115,700, we get 146%. Divided by 5 years, we get a 29.2% year-over-year return on that. Now, again, that is unrealized. That's something that we don't see that entirety of. We really need to do the calculation on what happens when we sell that property, right?
Yeah, I missed those numbers. What was the 5-year ROI?
5-year
in total, right?
Right, 146%.
146%, right? And then just to break that down. Everyone always gives you an annualized return. So anytime you see probably like someone's ROI, it's annualized. So that's why we want to break it down here. But what was that?
Yeah. So annualized return then is 29.2 rounded.
Okay, 29.2%. Now, we told you we were running with real numbers. So we want to go ahead and say, what would this actually look like if you sold it? Because you're going to have real estate fees, you're going to have closing costs, that kind of thing.
Right.
So we're going to take that 168 number that we had, and we're going to minus 6% of our sales price. So 670, it comes out to about 40K. You're going to pay about 6%, right? 5% in real estate fees, realtor fees, and then you're going to pay another 1% in closing costs.
Exactly.
So you're going to have 168 minus 40K. That's 128.
Right. So 128,597 is what we did on a 6% out for those fees. That is our net back into our pocket, right?
Yep.
$128,597. 128,597, which we calculate that back
to what was our return on investment with the 115? That ends up being 22%, right?
Yep, 22.2%.
22.2%. Perfect. So as an actual investment that didn't cash flow in year 1, that we've held for 5 years, realized returns came in, not even factoring in the tax benefits that we're going to go ahead and add in here as well at the very end. You got a 22% return on your investment for holding real estate. That was essentially, for the most part, look, you made $2,000 over 5 years in cash flow. It's a break-even property, right? Break-even property, but you're investing strategically in a good zip code that's going to go up in value, that has a lot of growth. You're investing in an economy like Phoenix. There's tons of big companies moving here. There's tons of people moving here, right? You're investing with a play in mind. It's not just I'm shooting from the hip and I'm hoping that this property goes up. No, there's real factors that we're benefiting from here.
And it helps that this is 3 doors. There's not a whole lot of those in this area of the city, right?
Yeah, definitely. Okay, so let's go ahead and what were the total tax benefits? The total tax benefits. Now we ran a quick simulation of your Schedule E. So what do all the deductions look like against this rental property? What does that look like over 5 years? Obviously, the bulk of the cost segregation study and the depreciation, that's $73,000 that you're going to take in year 1. That drastically drops off in year 2, 3, 4, and 5. But we just ran a quick simulation of what that Schedule E would look like, just to give us an overall a picture of how much money we're saving from Uncle Sam. And that was...
Well, we're going to depreciate in total in those years. And these are ballparks. Again, it really depends on how the cost segregation study goes, exactly how many things get to be depreciated down. But the total amount of depreciation, looking at this study, was about $123,000 that is deferred. With that means that at a 37% tax rate, the person who runs this is going to save $45,000. On actual tax bill.
So you got a 22% return. You got $128,000 back when you sold that property, and you got to defer $45,000 of taxes.
Right.
That you have now hopefully reinvested into other real estate deals, giving you similar returns as this.
Right. Well, I mean, what happens then if you spread this out and you look at what that money would have returned over the course of 5 years? That all of the dollars are back in there. If you reinvest that back into something else that's going to give you 22% return, you're looking at raising that $45,000 to $94,950.
Yeah.
You are more than doubling your the amount of money that you've saved in tax payment. You're more than doubling. So at the end of the day, if you end up in a situation where you need to sell the property, you need to pay the taxes because you've deferred them, and now it's time to sell the property, realize a gain, pay your kind of recapture the depreciation that you took. You've doubled what you took out, and so you can pay that all back and still have that much left over at the end of those 5 years.
Yeah, you start following strategies like this, you're going to hear a little bit of fear around, depreciation recapture, and that is a real thing to consider. But as long as you're strategic about reinvesting the tax savings that you do take to accelerate your portfolio, right, you're not going to have an issue. You're going to be getting enough returns to go ahead and offset most of that, if not all of that, depreciation recapture that you might experience down the road. And then there are all sorts of ways to go ahead and kick that can down the road. We can do a 1031 exchange. We can do a lazy man 1031 exchange, where we basically just take the losses from another property to offset the gain that you're going to get from selling that one this year. There's all sorts of ways additional to those two that I just mentioned to go ahead and kick that tax can all the way down the road. And our goal for all of our clients is to go ahead and own real estate for their entire life and die and pass that to their heirs, right? And when they do that, they get a step up in basis. All the tax depreciation, recapture, all of that resets. Your heirs do not have to pay that when we talk about eliminating taxes, right? We're talking in the sense of deferment, but when we can long play this and play it strategically for your entire life, we can effectively eliminate it by the end of your life, right? And so really cool things there. That is what we specialize in. We specialize in creating tax-savvy real estate plans for business owners, high-income earners, and we want to show you effective ways to go ahead and put that money that you're making from the business and from your job into real estate so that it can grow. The goal is not how much money you can make, it's how much you can keep. And when you start to realize and play that game effectively, you're going to out earn everybody who is on an equal playing field as you right now. You're going to fast forward 5 years and they're going to say, what the heck is that guy doing? Like, he's obviously doing something way different than I am. And so that's where we get a lot of our fulfillment out of. It's helping clients kind of really think through strategically how to maximize real estate in that way. So great.
Putting intentionality behind those investments is such a massive game changer for you.
Yeah, definitely. Well, hopefully you learned a lot in this video of underwriting. We wanted to really give a clear picture of something real, something that can be used in the future, and kind of give you a better sense of what real estate is what's possible with real estate and what's possible when you include kind of the full spectrum and the full benefits of it into your overall investment plan. So if you have more questions, let us know. Feel free to dive into the comments. You know how to get a hold of us. We're real people. We answer our DMs. We're actually on LinkedIn. We're on YouTube, whatever you want to contact us through. That's great. But hopefully you learned a lot of valuable information. Thanks. Have a great day.
Thanks, guys.